buzzsaw of bank quarterly reports?
Yeah, no, it's been, I'm a one-armed paper hanger today and this week, but and I would say, in general, the markets have reacted very positively to the bank earnings.
Yeah.
They,
Well, haven't they been maybe not completely, but mostly above expectations? Pretty good news.
I mean, the two themes that have played out is that we're at an inflection point in top line revenues. In other words, net interest income is now going to start growing. And then the other is that capital markets have been very robust. And what was hard to tell, September is always a big swing month for capital markets. And September proved to be a huge boom for M&A and debt capital markets. So the cautious guidance we got in mid-September did not include that month. And so that's where the beats have been. And people believe that we're in the early stages of a capital markets boom because we're below the 10-year averages on both IPOs and M&A. So the bullishness is palpable around financials right now.
Also, stocks go up 9 out of every 10 days, so the reactions are generally positive. We're in a new bull market, a sustainable plateau of higher valuations.
Yeah.
Jeff, I haven't seen you in a while. How you been?
I've been very well. I was out on the East Coast, seeing what's going on there. The fall is broken. It's nice, less fetid than normal. It's been an enjoyable week.
Your group seems to be a little bit more controversial.
Which group is that?
Consumer discretionary and retail as far as the reports that they're reporting.
Oh, baby. Dave and Buster's and Play. We got Build-A-Bear breaking out. We've got kind of the little unloved ones. And I'm going to talk about something later today. I'm buying a department store, which honestly, I can't even believe it myself. I'm a little grossed out by it, but here we are, and that's just going to be what we're going to have to talk about. But there's been a breakout. Listen, if Dave & Buster's is up 10% for the last week, it's Build-A-Bear. People are looking for kind of cheaper stuff out there. It'll be really interesting to see what the reaction is to Netflix. Netflix is going to crush. But, we've seen a lot of really good companies selling off just on either slowing growth or, we can't just keep kind of making people sign up with their passwords forever. So I don't think that you need necessarily the great results. The market's kind of looking past it.
The Netflix has
think about those LVMH results.
I was going back and forth with this about burn. I mean, it's 0% seems kind of fine-ish to me. I'm not sure who expected great things from wine and beer and expensive watches. I mean, just anecdotally, those are not selling, and also just there's plenty of evidence they weren't going to be. So I didn't think it was terrible, but again, it's a really hard market to sell, kind of just sell slowing improvement. You got the ELF problem, as I call it, having ridden ELF too long before I finally mercy killed it. There's nothing they can say. Eventually you stop growing at 100% and you have to take it down to 80, and this is a bad tape to do that. Where everybody wants to buy stocks, they just don't want to buy the most expensive ones on earth, which is
China too, right?
Sort of hanging out. What's that?
I mean, I said in China. It's like the consumer there is not in good shape.
And by the way, all those pops that we saw, those short covering pops, have all been reversed. They retraced almost all of them.
I'm shocked.
You're speaking about which, Bakes?
You say facetiously.
I mean, it's like there's no structural change at how they run the companies. It's like they're encouraging young people to join the Communist Party and not go work for the tech companies. So how can you get the stocks up if the companies aren't going to be doing any better, right?
Hey, Bakes, I got a question for you.
All right.
Are you using Bloomberg exclusively when you do your technical analysis? What's your source?
I use William O'Neill. I've used William O'Neill for, used to be called Wanda. I've used the big books in 30 years. Old dogs.
When I talk to my students at the Citadel and they're interested in technical analysis, I say, I think the dude has passed on, but just pick up any book on Amazon written by William O'Neill. So I say the same thing. He's the Investor Business Daily guy, right?
Sorry?
He's the Investor Business Daily guy.
Yeah, may he rest in peace.
Yeah.
Ironically,
all right, guys, we'll start in just a moment.
Yeah, with this fabled, set your stop and
All right, welcome back to Wall Street Beats, particularly our Beats Roundtable. Today is October 16, 2024. I'm your host for this particular session. I'm Paul Meeks, one of our tech voices, but we have some smart dudes on the show who I always like to hear from. Charlie Peabody is going to take a little bit of a dive into the financial sector. The guy that I lovingly call the third rail of consumer research, our buddy Jeff Mackey, talking about a blast from the past, bricks and mortar retailer. Very interesting. Kevin Baker, he's always going to give us the overview on technical analysis. And then my co-conspirator, Russell Young, has a lot to say about our tech sector. So let's start today with Charlie, if you don't mind. I'm really intrigued. And I said before we opened that you are in the buzzsaw right now of important bank quarterly earnings.
Yeah, today all the final lot of big banks reported earnings, and then the regionals will start reporting, for the rest of the week. But generally speaking, the reaction has been very favorable to the financial reports for two reasons. Net interest income, or top line revenues, are inflecting positively for the most part, and then capital markets is proving to be much stronger than anyone anticipated, because September had some, unique M&A activity and debt capital markets activity. So people are fairly bullish on the revenue outlook right now for the banking industry. In addition, credit quality remains benign in the sense that it is grinding higher in terms of non-performing assets, but in a very manageable way. And then expense control is very tight, and capital returns in terms of share buybacks are very robust. So I would say there's the bullishness right now is very palpable. But the one stock that did not trade well yesterday, and this is the one I wanted to highlight, is Citigroup. They reported earnings yesterday morning. They beat both on top line revenues and bottom line earnings per share. The stock sold off 5%. And when you listen to the conference call, you could get an idea of why the stock was selling off. There apparently were all sorts of rumors flying around on two things. The first was that a potential asset cap was going to be imposed on Citigroup, because Senator Warren had asked for that, given some of the problems they'd had with their consent orders. And that's just not true. It's just not going to happen. I mean, Citigroup is in the process of simplifying itself. It is downsizing its balance sheet. So an asset cap just doesn't make sense. And the company flat out stated on the call yesterday that they were not under any sort of asset cap. But that rumor was flying around, and there were a lot of questions on the call around a potential asset cap, similar to what Wells Fargo had and what TD Bank also just got imposed with. It is a new weapon in the arsenal of regulators, so that's something to be concerned about. The second thing that was flying around yesterday, and it's something we wrote about on September 22nd and posted on Wall Street Beats, and that is that is trying to IPO their Mexican consumer finance subsidiary, and they call it Banamex. And the goal was to do it sometime in the second half of 2025. They have to run that operation separately for a full year, and they won't finish separating the consumer finance bank in Mexico until the end of this year. So it pushes the IPO off to the very end of 25 or early 26. And that was disappointing to hear, but we knew that was coming. We wrote about that in September. So it shouldn't have been, new news to people, but that caught a lot of attention and disappointment. And there's some concern, that because of the way the judicial system is changing in Mexico, that it's going to reduce investor appetite for this IPO. So Banamex is valued anywhere from $7 billion on the low side to $10 billion on the upside. If you look at what's happened to the Mexican banks, they traded off 20% since this change in the judicial system in Mexico. So there's no question that the value of Banamex has been reduced. And so we'll have to wait and see a year from now what investor appetite is like for securities in Mexico. But that did cause some concern. The bottom line is, Citigroup is still very much on track to meet our earnings estimate this year of around $6. We're at 650 for next year. The street's at 7. So I think the street's going to have to cut their numbers for next year. But we still think it has good value. Right now they're doing a 7% ROTCE, which is abysmal. They've got a $90 tangible book value. So $63 is considered fair value if you don't price in any improvement over the next 2 years. I think they're going to be able to do a $100 tangible book value in 2026 and earn a 10 or 11% ROTCE. So I expect them to trade closer to tangible book value by that time. So I'm reiterating my buy recommendation on Citi with a 2-year outlook.
Well, it's excellent. Now, the beauty of our panel here, particularly today, is we have somebody talking about the fundamentals. Then we swoop in with Bakes, going to talk about some of the same names that Charlie just mentioned, but give us the technical perspective. Please go ahead, sir.
No, I appreciate that very much. Let's call up the chart of Citi if we have it and KBE if we don't, please. Okay, good, fantastic. Thank you very much. Really appreciate that. Citigroup, points in all the world. I wouldn't walk into this one. That's just me. This is an inside-out earnings day, meaning it took the cue from J.P. Morgan and Wells Fargo and others, and wanted to respond positively, poked above the 52-week high, and then reversed and closed at the low of the day with all the commentary that Charlie just outlined. Now, so that's a negative. I am kind of impressed that it stayed above this 60 level, and I think you'll learn a lot over the next few days. So I don't like to overreact to these things, especially if they don't take out big technical levels. 60 is the one that I'm staring at right now, and we'll learn a lot about how volume reacts and how people react when they calm down, they read the reports, and they decide what they're going to focus on over the next 3. If you have a 3-year time frame, then you might want to be in here nibbling if it stays above 60. Below 60, you're really doing some technical damage, and I get way more concerned.
Bakes,
let's go to the KB.
Yeah, so let me ask you about that, and let's meld the two thoughts between you and Charlie. If we hold 60, and Charlie, I have actually a long-term perspective, right? I believe that the returns will improve and your tangible book value will rise. Do you think 60 is a good buy limit if it looks like it's going to hold here?
I do. I mean, I am long Citigroup at with a 5 handle in my basis. But yeah, I think in a recession, I just don't see this thing trading much below 50% of book value. So 5 handle, if you're looking out at 2 years, is pretty attractive.
And you think, Charlie, that I don't want to say new leadership, but the last couple of years, a leadership change. Do you think she's doing the right things?
She is. I think this simplification effort and accountability of management is very important. I mean, Citigroup was too big to manage, and there was no accountability. And so you've had 3 or 4 management teams, for the last 2 decades that have never met, their goals. And I think she is proving, that they are able to meet their goals. They've done that now 4 or 5 quarters in a row.
Great. Bakes, what else you got for us, brother?
I have an ETF that I bought about a month ago, KBE. It's the Spider Bank ETF. Okay, this is Wells Fargo, which is the number 3 stock in the KBE. Okay, thank you. I own, but this red arrow that you see to the left, that's my buy point. I beat to the fire and keep myself honest. Bought this back in July, as it looks here, 17th, up 8% so far. And in this past week, with all the news that we've seen from Goldman and Wells Fargo, et cetera, to have new highs on 180% of average volume is pretty darn impressive. And I think this is the first time I've ever owned banks in my life, and I'm I'm going back through the memory banks, but I don't think I've ever owned banks. And something is happening here, as Buffalo Springfield would say. So I like the banks. Things are getting better. Yeah, the enthusiasm is picking up a little bit, but I don't think it's euphoric. And I follow the charts and the volume, and we have new breakouts on a lot of names, and the KBE looks great to me.
Bakes, did you just say Buffalo Springfield?
I did. You caught me.
I think
you get the Casablanca reference before too? Did you get Casablanca?
Only know that reference.
That's how old I am. Showing Casablanca and Buffalo Springfield on the same podcast.
Hey Jeff,
Charlie,
can we go to you and give us some of your thoughts?
First of all, just stop, children. What's that sound? That's the sound of Nordstrom going higher. I know the Buffalo Springfield too, baby. You can't get that stuff by me, Bakes. Listen, I'm going to Nordstrom. It's 69 days till Christmas, the nicest time of the year. And this is the time I'm looking for names in retail that haven't shot up higher, that haven't just had a rocket up their butt, because we're seeing a lot of these companies being punished, even the good ones, just for kind of slowing growth. You don't have that problem at department stores, and then some. But what you do have in the case of Nordstrom, and I love it when a technical comes, the technicals, the narrative, and the valuation comes together. And that's what you have here. Nordstrom, it's one of the few, in fact, the only department store really of Macy's, Kohl's, and Nordstrom, the triple crown of doom. But between those three, you've got Nordstrom that's actually working. They're seeing their sales stabilize. They've got digital working. They've got the rack business, which works out really well in a tight consumer world where we're seeing kind of good spending, but the high end's not great. It's really nice to have a discount chain operation. Their earnings are stabilizing, the revenues are stabilizing, and you've got a bid in from the brothers who have been trying to buy this thing for 7 years, the Nordstrom family, a troubled, honestly, endlessly interesting family, but they've been trying to buy it for years. They've got a $3 billion bid in with a Mexican concern. They can pay for it. Unlike the Macy's deal that we saw collapse, this group would be able to perform, and they don't need to bring in a ton of extra capital. And the stock's trading right through the offer, which tells me that I think the market believes and is right that the consortium can offer more. The companies that are involved in the takeover already own over 40% of the shares. It's kind of a natural. I think you can get like 26, 27 out of it fairly easy. You got 23 as your downside support. I think Nordstrom's not going to be public for long. It makes a better private company than a public company, and I think that's what's going to happen, and I think it happens at a higher price. So I'm long JWN. I don't feel great about it because department stores in general, I used to work at Macy's, man, and I still have PTSD. But right now, you can own the stock, and I think of the three, that's the only one you really want to own.
So you said, and I read your note this morning, Jeff, that the brothers have been trying to take this thing private for years. I think you said 7 years. And I remember 17, 18, it was all over the press and they couldn't get the deal done. But you think, based on the revised terms, let's say, that you actually think this company will go private?
But the price is down. There were bids for all three of those department stores, Kohl's, Macy's, and Nordstrom, at one point over the last decade or so. All of them fell apart. They were all rejected by boards who got a little greedy. The shares were much higher then. And at this point, the amount of money, the margins have really fallen apart for Nordstrom, even though they are making money. But the revenues are just kind of breaking even, which among the three, that's terrific over that time period. But it's no great shakes. I think it would take a lot of yarbles and not a lot of thought process for this board to turn down yet another offer after the experience they had. They turned down a bid for $50 a share. They said that they didn't want it. It undervalued the company. The company promptly fell to $12 a share. Right now, you're in the mid 20s. The jury's still out on how sustainable this turnaround is going to be. I think it works because I think this is the only department store that really they can feast on the dying corpus of Macy's and Kohl's for a while. But in terms of long-term plans, it's going to be the rack and it's going to be online. Nordstrom's better at that than the other two. It's the last department store standing, and they're just, eventually in 10 years, it'll be a lousy IPO, but it's a great takeout now. And in the meantime, you can own the shares.
And the companies run co-CEOs, the two brothers?
Yeah, they've got one. But co-CEOs you normally run away from, but in a situation like this, it's kind of a family operation, been run that way for a long time and done pretty well that way. So I'm not that concerned of it. One of them's basically in charge. The other one, they remind me of a Wes Anderson movie. Just a lot of guys wearing tweed and kind of thinking deep thoughts, and a series of endless tragedies coming out on them. I always kind of
That
just
does
have a
not
hobo
bolster
playing
your
in the back of my
investment
head when I
thesis.
listen to him talk. I picture kind of a rainy day and a bunch of eccentric Nordstrom kids running around. But I don't hold it against them. I find that much more compelling than what we have going on at Macy's. I love the company, and another thing is, this is the best time of the year. It's the only time of the year to go to these department stores. You need people there. They're kind of a joy to shop when they're crowded, when they're bustling, and they're very sad when it's not. So we're just outside of Christmas. Stop by Nordstrom. Do yourself a favor, buy some shares, and save enough to buy a nice sweater.
I was in Seattle the other weekend with my son to see the New York Giants play the Seattle Seahawks, and I went by the HQ. So I was right there, epicenter.
Really? Did you drop in? That might have been better than the football game, actually.
I should have, because you see what I wear. It could upgrade the wardrobe. So do we still have Russell Young with us?
I'm still
There he
here.
is. So give us your smorgasbord of tech, but also I'm going to hold your feet to the fire and ask you about this whole avalanche yesterday in semis and semi-capex with ASM Lithography's news.
Yeah. Hey, good morning, Paul. I think this continues to be a great stock pickers market because there's lots to do on longs and shorts. First, I want to call out we had 2 downgrades on Enphase, and there are people saying it's not tracking in line with estimates. I've been talking about this for a while, that in California, which is 35 to 40% of solar, batteries now rule the roost. And the Tesla Powerwall, it's lowest cost, cheapest to install, and it's microinverters. This Enphase story is falling apart. So I would avoid or stay short Enphase and potentially SolarEdge. SolarEdge is more Europe, but the story it's fallen apart here, and it's taken a long time, but it happens slowly then quickly. Second, I want to talk about Air Test Systems. Right, they had a beat and raise quarter, and the stock's all over the place. But importantly, yesterday, Wolfspeed, WOL, got some money from the CHIPS Act, and then got some money from the Apollo Group. Now, remember, Apollo came in when Carvana was hated and at its low. And Wolfspeed is super hated. It's been an EV disappointment story, but now the assets are below the capitalization of the company. And so now with this money, the company's not going broke. And Wolfspeed's going to turn around and become a customer of Air Test Systems, I fully believe. I think the industry is going to have to adopt Air Test Systems' approach, and this will mitigate the concern that ON Semiconductor is like 85% of Air's customer of their revenues, right? So Air has told you they're expanding to new markets, so the big bear story in Air is going to start to break apart as they add more customers into expanding to new markets. I also bought some Wolfspeed yesterday because they came out and said they're going to do $3 billion of revenue off their current assets. And they're approaching the point at which they have the capacity utilization up to 20%. And as you get to 30 to 40%, you start to break even from a cash flow basis. So I think we're at the turnaround in this company. They have the funding. It's super hated, and I think it's cheap enough that a year from now, that the sentiment and everything else on Wolfspeed is going to be a lot better. And then ASML, we need to talk about this because I've been concerned about ASML because they've been relying on this big price increase to really hit their numbers. And Taiwan Semi has been telling us, we're not going to pay it, guys. And what this, I think, is telling us is that Intel and Samsung are having problems, and they can't step up and give and become a competitive threat to Taiwan Semi. So Taiwan Semi is distancing itself from the competition. The stock trades at under 20 times forward numbers, and the street has it going, $10, $10. It could be 10, 12. They report tomorrow. We know the revenues because they've pre-announced, but when you're growing 40%, your expenses and everything else tend to come in lower than you expect, and you get margin power. So I'm super excited about that. And then, there's all these stories about the AI bubble. Is it over with ASML? I thought it was super interesting to see Google and Amazon getting and deploying small modular reactors. And They're adding gigawatts of power, and it's going to take them 3 to 5 years to put these things in. And so the big hyperscalers, they're seeing huge demands for power needed, and they're not slowing down. So from an investing a long-term perspective, the demands on power is extreme, and that's what's been taking utilities and the electrical infrastructure market higher. But the fundamental case on AI workloads is still very much with us. And then lastly, Applied Digital, we've talked about this. They had a bunch of analysts out to their North Dakota facility, and the feedback so far has been pretty positive. And that customers came out of this knowing that the 100 megawatt contract they're signing is really for the full 400 megawatts. And so there was some concern after the conference call that those were two different deals, but it's really one and the same. But I expect we'll see notes coming out today from the firms who visited. So still like that one a lot too.
So Russell, let me ask you about this. The narrative, at least from the bears on ASML, is the Chinese connection, right? That they're being negatively impacted by U.S. export restrictions. You didn't lead into that with your comments. What do you think about that bit?
Well, I think that's a concern. But I think if we can get this stock below $700, I think Taiwan Semi will fight their price increases and we'll get the orders back. But the numbers got to come down first. But clearly, we're blocking China from getting access to their technology and all semi-cap equipment, right? I mean, we are at a cold war with China, especially around tech. And that's going to be a headwind, but that's not going to be negative for Taiwan Semi. But so
I don't know the technicals like Biggs does. I use the very free and very cheesy stockcharts.com. But I did notice yesterday when I was looking at ASML's chart, Russell, that 700 looked like a pretty good point. If it was to get that low, that it might be able to find some support.
Yeah, I'm looking more at the numbers and say like, okay, $35, let's put a 20 multiple on that. And that should be where buyers would step in.
And of course, tomorrow night, we have not only TSM, but our buddies over at Netflix, if I recall correctly.
Right.
Yeah. And I know Berna made a very good point the other day that I thought we all expect Netflix to upside, but we don't know what the reaction to the upside will be. And so it'll be a nice tell because so far we've really only heard from the financials, but for some of these tech and aggressive growth stocks, how did they react to the news? Even if we know what the news probably will be.
Yeah, but
Netflix I know we're trading oriented, but Netflix is gonna crush it. I buy stocks with and for my kids, and that's just one of those that they have in their portfolio, and they're going to keep it in their portfolio. They're not whipping them around. I personally would just crawl under my desk in the fetal position if I saw it was long a ton of Netflix and got my face ripped off. With them, you just buy more. These guys are capturing live sports. They're the only ones that can crank out consistent content, and you'd have to chop off most people's fingers before they'd cut off their Netflix. Just not in a million years. It's become a staple.
Wouldn't you love to turn back the clock to the days when the stock collapsed by 50% when they stopped sending the discs in the mail? That was the buying opportunity of all time.
I mean,
it was one of the great ones.
To Jeff's point is they get to raise prices to try to force people to adopt the advertising cheaper products, which they'll actually could make more money on. And so it's a virtuous cycle of raise prices to help the subscription business and the advertising business. I mean, it's pretty remarkable.
And they're going to figure out, they're part of the NFL land grab. They're part of the live sports. The Tyson versus Jake Paul is an abomination, and it's probably going to be the most watched fight in the history of boxing.
Hey, I'm looking
Those two things are true. I'm going to watch it through finger. I love boxing. I hate the idea of the fight. I wish Mike would retire, and I'm going to watch it on live on Netflix anyway, and they'll be able to sell me whatever kind of ads they want to get me to do that. That's just untapped.
Some guy on a plane? Like a few months back, I saw it on video. So the guy beat somebody up in first class.
Yeah, he's a very bad man. He's a very bad man. But I think it's time for we Gen Xers should just declare ourselves champions for life and stop fighting people because your reflexes don't, in fact, get faster with age. It's weird.
Does anybody have any closing thoughts?
Yeah, from the general group here, if there's any indication of a reallocation out of tech into financials. I mean, financials are breaking out. There's no question about it. But is it coming out of tech, or is it I mean, I always joke that you could, take 10% of Nvidia and buy the whole credit card industry. But, you know,
I
is
mean,
that something you're seeing, Bakes, or is anybody else seeing that? The Mag 7 have definitely underperformed.
I think everyone's scenario was that if money came out of the Mag 7, the S&P would just bomb and we'd all be doomed and getting in our shelters. And what seems to be, they're so huge that, you're seeing a lot of sectors break out, a lot of the ignored ones, a lot of things that we talked about, Dave and Buster's and Play. I know I keep mentioning these terrible Build-A-Bear workshop type of companies, but, you could buy a zillion of them with 5 shares of Nvidia. I mean, it's and I think you're just seeing a transition. Home Depot, a huge company that's breaking out ahead of any good news. And so I think you're seeing a reallocation, not just into financials, but also into just kind of across the market. It's your best case scenario for sort of let these Mag 7 chill for a while and let the rest of the market catch up, which is a really healthy rotation in general. I mean, it's
Hey,
a
Charlie,
little bit of a
I'll talk about this. I'll talk about this tomorrow, but there's definitely distribution in the S&P, and I'll highlight that tomorrow. But I also wanted to give you props. You asked for my honest assessment of Citi, which I gave, but I want to just give you some love too. Wells Fargo, you were here a week ago. Great call, up 10%. It's the number 3 name in KBE. Apollo is number 1, by the way, and nice call. And you're making money for subscribers, so God bless you.
Oh, thanks.
Bakes, I love that, man. Appreciate it.
Yeah.
All right, guys. Well, let's sign off. I'm Paul Meeks saying goodbye to all my buddies here on the panel, and we're going to see you tomorrow.
Keep smiling.
Thank you, gentlemen.
Well done, Paul.
Nice job. Have a great day.